president and CEO of Gerber Kawasaki. Ross, thanks so much for being with me. We were just listening to an argument put forth by a strategist who said, now's the time to take chips off the table in those big tech stocks. The valuations are getting too stretched and rotate to some more unloved parts of the market. How do you respond to that?
That strategist is probably not one of my neighbors in the Pacific Palisades, because that's not how you get rich, my man. You know, it's like you got to invest in what's happening and not run away from it just because, we're in stage one of the AI growth story. So I get where you look at valuations and you say, oh, this could be stretched or whatever. But I also think that we're entering a new period of time that almost every tech innovator has said they have never seen anything like this. So I think I'm going to bet on the side of the tech innovators.
And yet you have to be prudent, right? With the risk and that you're taking when you're allocating money. When you think about that word valuation, what does it mean to you when you're allocating dollars, betting on a company that could ride this wave?
I think one of the differences between the way we value companies than many analysts is we use a simple metric called PE to growth rate. So we don't just look at the pure PE, we look at the forward PE based off estimates, and then we compare it to what growth is expected for the company. And that's what makes many of these AI plays not expensive in our book, even after this rally. Even stocks like NVIDIA trading at now maybe 30, 32 times forward earnings, this is not a crazy metric or valuation, especially for somebody like me who grew up sort of in the dot-com bubble and all this kind of stuff. So we haven't entered bubble territory even close yet.
Let's take some of these names one by one. Meta. I mean, the results were so solid in terms of growth, in terms of profitability. They've instituted this dividend. They're doing a buyback. They're also increasing their spending plans, right? To spend on growth, to spend on innovation. That's a lot of demands on this company. Are you worried that they're stretching themselves too thin and trying to do all of these things at once?
Well, I think it's all focused around the same goal, which is efficiency through the use of AI. And Meta still is an ad platform first and foremost for advertisers. And we've seen advertisers increase their spending. We've seen Meta cut their costs, and they're doing a lot of things that will improve the product through the investment in AI. And so I think really they were less focused when they were focused on trying to be, an Oculus VR company. And so they're actually probably more focused now than they were maybe 2 or 3 years ago, and that's why they're having such good results.
Of course, Meta is not in China, but they said on the call that about 10% of their ads are coming from Chinese-based companies. I wonder if that's a risk, because we've seen the China risk play out for Apple.
No, I think it's the opposite. Those are companies trying to get into the United States, like Temu and Shine, and so they're probably spending money on U.S. Advertising, because these companies are trying to make moves into U.S. markets.
Let's talk Apple, though, because I brought it up. I mentioned you own the Magnificent Seven, including Apple. How much of an enthusiastic shareholder are you these days?
Well, Apple's a pretty boring company, to be honest, and we've been saying Tim Cook is probably the most boring CEO in the world. And part of that is good, especially when you're a Tesla investor, to offset, the most crazy CEO in the world. But with that, Apple Vision Pro has been launched today. We're very excited. We haven't gotten ours yet here at the company, so we're waiting to get it and test it. But we've seen some pretty good results so far. I don't know if this product or itineration of this product is the game changer that it will be in a few years, but I think it's the beginning of something really great for Apple. So they need something to grow the needle on a hardware side, and I think these are the right moves for Apple. So we love Apple, but we don't think it's a cheap stock, and we don't think it's very exciting relative to a stock like NVIDIA or Microsoft.
You mentioned Elon Musk on the other side, and there's been a lot of issues around his compensation and his pay package. But I spoke to somebody yesterday who's an investor in this space and said, if you look at what Musk had to agree to back in 2018 when he got that package, he's earned it. It sounds like a lot of money, $55 billion, but he's earned it.
Yeah, I mean, I voted for the package at the time, but I don't think that's what the Delaware court is saying. It's not an issue of whether he earned the compensation. The issue is the fact that the board of directors is not independent, and what they sent to shareholders in the proxy was misleading in that it marked several independent directors as independent that aren't independent. And so by misleading investors, that's really what the judge said, voided the vote, and that there's a requirement of fairness that the board. So if Elon would have been comped $5 billion instead of $50 billion, would that have still been enough? And I think that's the argument that Delaware is making, and I think it's a valid argument. Tesla's board is conflicted, it's not independent, and it's completely controlled by Elon. And that's what the court ruled, and that's what we believe as well. So this is just a made error, a typical Elon mistake, and then, there's nobody to blame but the board of Tesla.
But doesn't seem like it's shaking your confidence in the company as a stock to own.
Well, we've lowered our position in Tesla over the last 6 months. If you look at our public record of 13Fs, and we do believe in Tesla in the long term, but this period of time for Tesla is going to be extremely challenging, and some of the things that are happening are a bit troubling. So we've reassessed our position in Tesla. We're holding on to the stock that we have, but we have lowered our position, and we think investors should be concerned about Tesla because the valuation is high and the CEO is unfocused.
What would it take for you to change your bullish stance towards the group?
I think it would be economic, where I think if we really saw a bad economy where, sort of like in 22, where ad spending comes down and people have less money to spend on the discretionary side, that this would hurt the Mag 7 because they're almost like a tax on the overall economy of the world. And so they're kind of economically sensitive. But what we really see is the economy still being very strong, with the Fed having the ability to lower rates going into this year to support growth. This is actually an ideal environment for these companies now that they're getting leaner, focusing on profits, even paying dividends, and the valuations are high but not outrageous. So we're very bullish on this area of the market over the next probably 6 months, and as we get into the election, we'll see what happens.